So let's get right to our question. Question reads, Nico PLC is a large company operating across the country. It is purely equity financed and has year-end of 31st December. Currently, the company has to fulfill a particular contract in Abuja, and it can do this in one of two ways. Under the first proposal, it can purchase plant and equipment and machinery, while under the second proposal, it can use a machinery already owned by the company. So those are two options the company is looking at. The year-end operating net cash flow in nominal bracket money terms and before tax are as follows. You can see that it gives us this value in what is called money cash flow or nominal cash flow. So guys, what does that tell us? What does it tell us? Those items that we have down there, the values we have down there, the fact that the question tells us that those items are in money or nominal cash flow, what does it automatically tell you? Does it tell you that those items have been adjusted for inflation or they have not been adjusted for inflation? What do you think? I just want us, at least we're going to take it slowly since it means that they have been adjusted for inflation. Thank you very much. So we explain inflation. Thank you very much. So we explained it here, right here. So we said that the money cash flow is also called nominal cash flow. So let me add that term in there as well. So it's called money or nominal cash flow. Like that's been adjusted for inflation. So what that means is that when you want to discount, the rate of return you will use must be the money rate of return. That is what you must use. So if the question gives you a rate of return that is not the money rate of return, then you might have to calculate it yourself using this formula. So you begin to give you an idea of what direction the question is heading to. So let's get right back into it. Let's get right back into our question. Okay, so it says the year-end operating net cash flow. So we were given the value. So this is proposal 1, and this is proposal 2. Assume today is 31st December 2023. So this is the year after. So 24, 25, 26. We're in December 2023 right now. Proposal 1. Under this proposal, the company will incur an outlay of 312,500,000 on 31st December 2025 for the purchase of plant and machinery. So it's going to purchase plant and machinery under proposal 1 for 312,500,000. The labor force required under the proposal will have to be recruited locally, and budgeted wages have been taken into account in preparing the estimates of future nominal net cash inflow given above. The plant and machinery is expected to be scrapped on 31st December 2026. The nominal cash proceed at that date being projected at 25 million. So when we buy that machinery, we use it to operate the business if that is the option we choose, because that's proposal A. In 2026, we're going to sell that machinery at 25 million. That's the first proposal. Buy the machine at 312,500, sell it at 25,000, and then we have what the inflows will be given to us. Now let's look at proposal 2. The second proposal covers a 2-year period from 31st December 2023. It will require the company to use a machine which was purchased for 750 million a number of years ago. Now, when you read that line, it says a number of years ago. That should automatically take you back to what we discussed about relevant costs. We said that for a cost to be relevant, let's go back quickly. I'm taking this calmly. It says it must be what? 3 things. It must be directly attributable to the project. It must be future cash inflow or outflow. The machinery was purchased a number of years ago. Is that future? Guys, is that future cash flow? Is that a future cash flow? No. It's already been spent a number of years ago. So that tells you that 750 is not relevant. So we don't need to see it anywhere in our solution. So let's get on. And has been fully written down for tax purposes. The company has no current use for the machine, and its net realizable value at 31st December 2023 is 250 million. However, if retained unused, there would be no incremental cost of keeping it, and it will be sold on 1st January 2025 for an estimated 300 million in nominal money terms. If used under the second proposal, which is our proposal B, the expected residual value of the machine will be 0 at the end of the 2-year period. The labor force required under the second proposal will be recruited from elsewhere within the company, and in end year nominal cash flow terms would be paid 100 million and 108 million respectively for 2024 and 2025. However, the staff that would have to be taken on in other departments to replace those switched over to the new project would, in corresponding end year nominal cash flow terms, cost 110 million for 2024 and 118.80 million for 2025. The year-end nominal net cash inflow of 350 million for both 2024 and 2025, which are associated with the second proposal, are after deducting the remuneration of the workforce actually employed on the scheme. Working capital, we'll come back to all of that when we're doing proposal B. Working capital in requirement in nominal money terms at the beginning of each year. Can you see? It says at the beginning of each year. And when we talked about timing of cash flow, we said if something happens at the beginning of each year, we assume that it is the previous year. So keep that in mind. So the working capital requirement in nominal money terms at the beginning of each year are estimated at 10% of the end year operating net cash inflows referred to in the table above. The working capital funds will be released when the project is completed. Yeah. Expected annual inflation rates over the next 4 years. So these are the inflation rates. The company's real cost of capital is 10% per annum. Oh, yeah. So we can say it. The question gives us money on nominal cash flow, and it's giving us real cost of capital. But from what we explained before, if you have money on nominal cash flow, you should use money on nominal rate of return. So we need to calculate to make an adjustment. We have the formula given to us already. Income tax is expected to be 40% over the planning period. Capital allowance are available on plant and machinery at 20%, reducing balance. You can assume that the company generates sufficient taxable profit to relieve all capital allowance at the earliest opportunity. Required A, calculate the net present value at 31st December 2023 for each of the 2 mutually exclusive projects. B, indicate briefly any reservations you might have in basing an investment decision on these figures. Note, calculate to the nearest thousands. So what that means is that whatever values we get, we take out 3 zeros. So that is the nearest thousand. That's what it means. So if it's 10 million, take out 3 zeros. That leaves us with 10,000. That's what it means. Show all calculations clearly. We're going to do that. Repetition of a project is not possible. Okay, so we're just going to do one or the other. We're not taking both, and we're not repeating any of them. Okay, so that's our question. So let's get right into it by applying the principles that we have considered up to this point. So we're trying to evaluate or calculate the net present value for each or of each of the two mutually exclusive projects. So when we say projects are mutually exclusive, basically means that you cannot undertake the two. You can undertake either A or B, or if there are three, you can undertake either A or B or C. You cannot undertake two projects really. So that's what we mean by a mutually exclusive project. So we're trying to calculate the net present value of each of the two proposals. So there are two proposals, guys. They are proposal A right here, and we have proposal B right here. So let's begin with our first proposal, which is proposal A. So let's begin with our proposal A. Yeah, so we're on proposal A. Now keep in mind that NPV is inflow minus outflow. However, to keep things standardized, we have a format that we can use. So sometimes in exam questions, sorry, I'm just going back to our format quickly. Yeah, so this is our format right here. So sometimes in exam question, you might have a question that gives you sales variable cost. So you know that you need to begin with your sales variable cost, and then you continue. Sometimes you might have a question that starts from contribution, meaning that from contribution, we're not going up, we're going down. So it gives you contribution and then other information after contribution. So you have your contribution, your fixed costs, your net operating cash flow. Sometimes you have a question that gives you information from net operating cash flow. And sometimes too, you have a question that gives you information from net cash flow. So what we have determines where we're going to begin our computation from. So let's look at proposal A and ask ourselves, are we giving information on the sales variable? Or are we giving information on the contribution? Are we giving information on the net cash flow? So whatever we have, that is where we would start our solution from. So let's go right back to our question quickly. Under the table that has data and see what we're given. It says here, the year-end operating net cash inflow. The year-end operating net cash inflow in money terms before tax are as follows. So let's quickly go back to the format we presented. Where do we have net cash operating cash flow? So we know where we started our computation from. We have it right here. So what that means is that for this question, we're not bothered about sales. We're not bothered about variable cost. We're not bothered about contribution. We're not bothered about fixed costs because they've done all of this computation up to this point, and they're giving us the value at the net cash operating cash flow. So please, very important to think of that. So let's do our computation then from net cash operating cash flow. If you have any question, guys, at any point in time, feel free to raise your hand and I could always attend to you. But very important, breaking this down so we understand the principles very well. Okay, so we have our net cash operating cash flow. So the years are 2024, which is our first year, 2025, which is our second year, 2026, which is our third year. We might have this extend to year 4, depending on if there's any transaction that goes outside of 2026. We might also have this go to 2023 if we have any transaction that takes us to 2023. But right now, based on the table we have, which we're building from, we have the net cash operating cash flow for these 3 years. These are the values: 200,000, 275, and 350. 200, 375, and 350. So let's put that down quickly. So 200,000. Don't forget the question says that our answers has to be in thousands. So let's go back to that our table and see whether they've already taken out 3 zeros from this 200,000. And if not, we'll have to take out 3 zeros from it. So let's look at our table quickly and see. Okay, so they've already taken out 3 zeros. So we don't need to take out the 3 zeros again. So they've already taken out 3 zeros. So we have 200,000, 275,000, and 350,000 as our net cash operating inflow. From the format we discussed, the next item after that, if nothing else happens, would be our taxation. If nothing else happens in the question that allows us to make any adjustment, the next item would be our taxation. So let's look at what we have under A and see if there's any other item that might require that we adjust anything. So this is investment. Investment comes later on in our format. Yeah, and scrap value. So that is all. So there's nothing else. So that means that the next item would be our taxation. So let's bring in our taxation quickly. Oh, sorry, I have not put in the other values. So 275,000 and 350,000. So let's bring in our taxation. Now, whenever you bring in any value, any item, always keep in mind the timing of cash flow and ask yourself, when is this cash flow? When does it happen? So let's look at our taxation, which is the next item on our calculation. It says income tax is expected to be 40%. That's pretty straightforward, 40%. Over the planning period, tax being payable 12 months after the accounting year end. So if I have a 2024 tax and it's payable 12 months after, what year do you think that tax will be paid, guys? I have a 2025 tax and it's payable maybe December 2024, its tax is 10,000 and it's payable 12 months after. Guys, when do you think that tax will be paid? When do you think it will be paid?
2025.
2025. If it was payable 24 months after or 2 years after, you know that it's 2 years ahead, but it says 12 months after. So bear that in mind when we are placing our tax. So the tax is 40%. So let's do a computation and then place it right. Okay, so our tax is 40%. So what that means is that for 2024, it will be 40% of the value. So I'm trying to get my calculator. Yeah, so that will be 200,000 multiplied by 0.4. That is 80,000. That 80,000 is payable 12 months after. So that means the next year, it would be 80,000. This is our 2024 tax. Our 2025 tax is 40% of 375,000. So that is 0.4 multiplied by 275,000. That is 110,000. It is paid 12 months after, meaning you'll be paid the next year or the following year. So that would be in 2026. And then finally, our 2026 tax. So this is our 2025 tax. I could just put it in brackets so that you know that it's for 2025. Our 2025 value is 350,000 multiplied by the tax rate of 0.4, which is 40%, 140,000. Is payable 12 months after, which is the next year, 140,000. That is our 22. So that means that our project has extended by 1 more year. to 2027. So let's put it in bracket to show that it's an outflow. All right, guys. So that's our tax. Any concern on taxation? Okay. So if there are no concern on taxation, let's move on to the next item we're focused on based on our presentation format. So once you have calculated tax, which you've done, based on our presentation format, the next thing we would consider would be the tax allowable depreciation or tax savings on capital allowance, if there is any. That's this. Tax savings on capital allowance, which is this. Okay, so let's get that in. Okay, so let's get that in quickly. Okay, so let's do our tax savings on capital allowance or tax savings on tax allowable depreciation, depending on what term is used. Let's call this working one so that we can do some computation on this below. So that we don't go far, we can use here for it. So we can call this our working. Oh no, let's use the next page so that it doesn't interfere with our number calculation. Okay, so let's call these our workings. Right, so let's call this our workings. So tax savings on depreciation or tax allowed depreciation or capital allowance, depending on what term is used in the question. Okay. Now, I want you guys to note two things because you're going to find that this will be treated differently in different questions in the Pathfinder. I'm just going to speak on the two methods, but I'm going to stick to one in all of my calculations going forward. So in every other question we'll solve, we'll stick to this particular method because I like consistency. I would like students to just focus on one method and know it well, rather than going to know different methods. And then in exam day, they will not be spending time trying to decide, should I do this method or that method and all of that. So now there are two methods that you would find in the Pathfinders. The first method is the cost minus scrap value. The cost minus scrap value approach. The scrap minus scrap value approach. What do I mean by this? So if, for example, you are using the straight line method, what we basically mean would be, it would be the cost minus the scrap value divided by the number of years. So that's one approach. Now, if this approach is used, or you decide to use this approach, always bear in mind that the scrap value is subject to tax. So if you use the approach and maybe the scrap value is now 30 million, always know that you pay tax on the entire 30 million scrap value because of this approach. So that's the first approach you're going to find. So the depreciation every year would be cost minus scrap value divided by the number of years. And if it is a reducing balance method, it will be cost minus scrap value, then multiply it by the annual reducing balance percentage. So that's one method you're going to find. And the second method you're going to find would be what is called the balancing charge versus balancing allowance approach. Now, in practice, when I say in practice, in real life computation, analysis, and investment appraisal, this is the method that is often used. That method is often used. So I would stick to this method for all of our computation. Now, how does this method work? One, we're going to calculate our depreciation or tax allowable depreciation based on the cost / reducing balance. So what do I mean by that? If I'm using this method and I'm trying to do a straight line basis value, if I'm trying to determine what the value will be in every year, I will just do whatever the cost is. I will not subtract scrap value. I will just divide it by the number of years. And if I am doing reducing balance method, or whatever the cost or the opening balance is, I multiply it by the rate. I'm not subtracting scrap value. Now, if I adopt this method, it therefore means that in the final year, of the project, we will always have what is called a balancing charge versus a balancing allowance. And how do we calculate that? We're going to do that with the example, but just for the theoretical part of it's important to understand the concept at this point. And that would be basically the balance at the beginning of the year, which is called tax written down value at the beginning, minus the disposal proceed or scrap value. So whatever you have, if you make a profit, you pay a charge or a tax on it. And if you make a loss, you get an allowance on it. If you make a loss. So whatever method you use, you're going to arrive at the same value at the end of the day. So let's recap the two methods. First method, cost minus scrap value divided by number of years, or cost minus scrap value multiplied by what the percentage is every year. And then when you finally sell the machine, you pay tax on the total value that you sell the machine as scrap value. That's option one. Option two is to say, let us calculate the tax allowable depreciation on the total value without considering the scrap. But then in the final year, we will compute what is called a balancing charge or a balancing allowance. And we do that by comparing what our opening balance is minus whatever we sold the asset. If we make a profit, it's called a charge. We pay tax on it. If we make a loss, it's called an allowance, and you get some form of a deduction on it. The second method is what is basically used in practice. So I'm going to be adopting this method, and I would stick to this method for all of my solutions. So even when in some pathfinders you might have this approach that is used, I'm going to stick to this one for consistency. So, but it's important that you just know that there are two methods on that. So with that said, let's go back to our question. So we're going to determine the tax savings on capital allowance. So let's do that quickly. So this is what the question says on capital allowance right here. All right, so let's read that part. It says, capital allowance are available on plant and machinery at 20% reducing balance. You can assume the company generates sufficient taxable profit to relieve all the capital allowance at the earliest opportunity. So the capital allowance is basically on reducing balance. So let's now look at what the values are then. Look at what the values are. So what is our value of plant and machinery? So a value on plant and machinery. Where's that value? Plant and machinery, Where's the value? Where's the value? How much did we buy plant and machinery? Other people like A. Where's that? Plant and machinery. Yeah, somewhere here. Yep. Okay, no, it's not there. Yeah, it's right here. It says, under this proposal, the company will incur an outlay on 31st December for the purpose of plant and machinery. So that is 31,500. We're taking off 3 zeros. So that will be 312,500 on 31st December 2023. So let's do a computation then. Capital allowance on that value at 20%, reducing balance. Okay, so let's do that. So we're doing method A then. So we have our opening balance, or maybe just call it balance really, since I'm just using a SQL value. Okay, now let's do opening balance. So I might have the year here. I'd have opening balance. I have the tax allowable depreciation. Then we have closing balance. We have tax savings. And then we have our timing of cash flow. So we have our tax savings, and then we have our timing of cash flow. Our machinery is bought on 31st December 2023. We bought the machinery 312,500. Our tax allowable depreciation is 20% on that value. So how much would that be? So that would be 312,500 multiplied by 0.2. That gives us 62,500. Our closing balance. So let me label them. So this is A. This is B. So this is basically A multiplied by B. Our closing balance, which is C, is equals to A minus B. So we have opening balance of 312,500. We have a tax allowable depreciation of 62,500. For closing balance, I'm going to come to the last two much later on. Let's do this first. This other one's pretty straightforward. Closing balance is A minus B. So that would be 312,500 minus 62,500. And that gives us 250,000. Our closing balance becomes our opening balance the next year, which is 2024. Now, don't forget, we said, as you are doing this in the final year, you have to pause, because in the final year, we would have a balancing charge or a balancing allowance. All that final year question. Okay, that's 2026. All right, so let's go there. So our following year, which is next year, 62,500. Sorry, 250 rather, closing opening. So 250,000. Great. Our tax allowable depreciation, so this is year 1, this is year 2, would be 20% of that. So what do we have? 20% of the new balance. So 0.2 multiplied by 250,000 gives us 50,000. Closing balance, 250 minus 50, which is A minus B, gives us 200,000. A third year, 2025. So you have 200,000 closing, 200,000 here as opening. Our tax allowable depreciation is 20%. So that would be 200,000 multiplied by 0.2, which is 40,000. Okay, so 200,000 minus 40,000 gives us 160,000. So we've done for 3 years. For 2026, is that our final year? Let's look at our values in the competition. Is that our final year based on the project values? What year is 2026? Is that our final year? Yes, 2026 is our final year based on our projected cash flow. So in that final year, we would have a balancing charge or a balancing allowance. That would always happen in the final year. Okay, so let's look at our final year value computation then quickly. It's down here. So that's a final year. Okay, so a final year would have a balancing charge or a balancing allowance. Okay, so let's do that. Our tax written down value, which is the balance at the end of the year before the final year, is 160,000 minus the disposal proceeds. So how much are we selling this equipment? Let's go to our question and see how much we're selling the equipment, which is our disposal proceed. Okay, it mentions somewhere machinery A. Where's that? Where's that? Where's that? Where's that? Where's that? Yeah, it says that the plant and machinery is expected to be scrapped on 31st December 2026. The nominal cash proceed at that date being projected at 25 million. We're taking off 3 zeros, don't forget. So 25,000 is what we'll sell it in the final year. So let's bring that our disposal proceed in. Okay, so 25,000. All right, guys. So the balance of the cost of the machinery is 160,000. We then sold this machinery that has a cost balance of 160,000 at 25,000. Are we making a profit or a loss on that sale? The machinery, the cost of the machinery in terms of the balance as at the final year is 160,000. We then sold it at 25,000, guys. Is that a profit or a loss? It is a loss because we're selling it below the net value. And if we're selling it below the net value, it is called, we claim an allowance. It is called a balancing allowance. If we're selling it above the cost value as at that point in time, it's a profit, so we pay tax on it. We call it a balancing charge. So how do you easily know that charge? You're spending something. You're being asked to pay something. That's the charge. So a charge would be if you need to pay something. An allowance will be if you're giving you a relief because you're making some form of some form of loss. Okay, so what's our balancing charge? It is 100 and sorry, balancing allowance rather. It is 135,000. Okay, guys. So I'll take questions on that if there are any, but let's plug the values in. So the value here is an allowance, 135,000. At this point in time, we turn attention to just this part because these are the tax allowable depreciation. However, what we're interested in is the tax savings. We're not interested in tax allowable depreciation, but the tax savings on those depreciations. So how do we calculate tax savings? Very easy. It is by multiplying the tax allowable depreciation by the tax rate. And that will give us the tax savings. So what's our tax rate? Our tax rate is 40%. Our tax rate is 40%. So can we know what the tax savings is on the tax allowable depreciation of 62,500? What is the tax savings? Multiply that by the tax rate. So that would be 62,500. 62,500 tax rate of 40% gives us 25,000. And that would be in year 1. Year 2, our tax allowable depreciation is 50,000. Can we know what the tax savings is on that value? Yes, just multiply that amount by the tax rate. Multiplied by 0.4, which is 20,000. That would be for our year 2. Our next year, the tax allowable depreciation is 40,000. We want to know what is the tax savings as a result of that tax allowable depreciation. Can we know what it is? Yes, multiply that value by the tax rate of 0.4, which is 16,000. The final year is an allowance, so we treat it the same way. 135,000, can we know what the tax savings is? Yes, we can. We multiply that by the tax rate, which is 54,000. Now, if this was a charge, not an allowance, this value would be negative because we're going to be paying tax rather than getting an allowance. But because it is an allowance, it's going to be a positive value. But if it is a charge, we're going to subtract because we're paying tax on that value. So please, guys, just take note of that. So let's copy our values into our solution quickly. So we have our year 1, 25,000, year 2, 20,000, year 3, 16,000, and year 4, 54,000. So let me copy that in, and then I can pause and take questions on this approach. Very important that we get it right, guys. Very important. So the tax savings. So 25,000, 20,000, 16,000, and then 54,000. If this last one was a charge, you know what, you made a profit, instead of adding it, you would subtract it. Please just take note of that. Let me pause a little bit, guys. Is there any question on the tax savings on capital allowance? Like, I find out that sometimes students have a second look at this part. We're taking it slowly, guys. That's why we're starting early. So if you have any question, please feel free to signify so we can discuss it. Any question? Okay, so let me take that approach one more time quickly. So this is one method. The other method, you can use it, you still arrive at the same final net answer in your solution if you use the second method. I am not going to be using the first method in any of my solutions because I want you guys to get used to this because this is the method that works in real life. So what do? For this approach, we calculate our depreciation initially without making use of the scrap value. So if, for example, it was straight line method, we would just do 312,500 divided by the number of years. And then we'll do our calculation based on that. So that will give us what the values are: 2025, 2026, 2027. So that gives us what our values are. Sorry, 2024, 25, 26, 3 years. It gives us what the tax depreciation value would be for every single year. So that would, if we're using a straight line method, that would have been 312,500 divided by the 3 years. That would give us what the value would be for this, for this, for this. It is going to be the same value for all of these years. So we'll just be subtracting. And then in the final year, you're going to say, okay, can we see if we have a profit or a loss from the sale of a machine in the final year. That is by comparing what the balance is with the disposal proceed. If we make a profit, it is a charge. They're going to charge us tax, so that's why it's called a charge. If we make a loss, it will be a balancing allowance. All right, guys. So we're good. We've done, let's go back to our presentation format quickly. I want us to get used to that and stick to it. So I don't want to go out of that so that we get very much used to it. So we've done our tax savings on capital allowance. Now the next item, if there is tax savings on loss carried forward. In this question, we don't have any loss, and the question doesn't provide for loss carried forward. So that is not applicable to this question. In the next question we would solve, I think there's a loss in that one, so we can learn that. But if there is not, I'll just extend that further. So we don't have any loss. So we do not have anything that has to do with loss carried forward. So we skip that step. We skip that step. The next item after this, if it's applicable, would be our investments and then our working capital. So let's look at our format quickly, and then we can bring in those two items. Yeah, so the next two items would be our investment and then our working capital. So let's begin with our investment. How much are we investing into the business, and how much are we expecting to get if we do sell the machinery at the end of the day? So let's bring in our investment now. So let's bring in our investment. Yeah, so how much are we spending to buy plant, machinery, equipment, furniture? The question says, yeah, where's that? It says here that under this proposal, the company will incur an outlay of $312,500 on 31st December 2023. Always pay attention to timing for the purchase of plant and machinery. Okay, Jamie, I think your hand is up. You can go ahead before I proceed.
Yes, sir. So my question is on this capital allowance, issue of the balancing allowance or balancing charge.
Okay, please.
So I need you to shed more light on it.
Okay. So let's take a minute and go back right there. Right. So let's go back right there. Yeah, we're right there. Okay. So this is the approach on that. If you choose to use this second method, which is what I would be using. So if you want to learn this method, you might check, maybe some other questions would have this method in there, but I will never use it because I don't want to go in between method for you guys. So I'm going to be sticking to this. Now, if you do use this method, which is the balancing charge or balancing approach method, what it basically means is that for every year that the project is in existence, you are going to calculate the capital allowance on the cost or the balance. So if depending on whether you're using reducing balance or you're using straight line method. So if you are using straight line method, it will just be the cost divided by the number of years. So that value is what you will have here. It's going to be the same because it's straight line. So that will be 312,500 divided by the number of years. The project is the regular project itself, not all those extension, is 2024, 2025 to 26. So that's 3 years. So that will be 312,500 divided by 3. So that's the value you would have here. So you now have 312,500 minus whatever the value is, gives you the closing. Closing becomes opening. Closing becomes opening. That's what you do. If it's reducing balance, the term is reducing balance. So you're applying the percentage on the balance that you have reduced. That is why it's called reducing balance. So this is the balance at the beginning. We applied it. This is the closing balance. And so the balance has reduced now to 250. So the next year we apply the rate on the reduced balance. And the following year we apply the rate on the reduced balance. That is why it's called reducing balance approach. Now you're going to do that for all of the years except for the final year. So when you're always doing this competition, always keep in mind what is the final year of the project. And from our question, we have it right here. Where's that? Yeah, right. Where's that? Yeah. So we have it right here that our project is 2024, 2025, 2026 at our final year. So that means that whatever you do, once you get to 2026 or the final year, you have to pause. Because in that final year, we're not going to do our regular calculation. Rather, we're going to determine whether or not in the final year we have a balancing charge or a balancing allowance. And how do you do that? You look at the balance the year before that final year as the cost value, the closing cost value, called the tax written down value. You then compare that value with the amount you're going to sell the machinery. So when you compare or you subtract the two, if you are making a profit, in other words, your sales is more than the cost, that's the profit. You pay tax on it. That becomes a balancing charge. But if what you sell it for is less than the cost, so there's a loss from this sale, we call it a balancing allowance. So if it's a balancing allowance, you treat it like the way you've been treating all other ones. But if it's a charge, you're going to pay tax. So instead of it being a positive value as a savings, it's going to be like a charge to you. You have that subtracted. Is that clear, Jamie?
Yes, sir. It's clear, sir. Thank you very much, sir.
All right. Thank you. Yeah. Yeah, guys. Okay. So let's get that in. All right. So we're back to our next part, which is our investment. Our investment is 312,500. Now you must always pay attention to the timing. When will this happen? When are we making this investment so that we can place it under the right year or column? Education mentions that the investment is made on 31st December 2023. So we have to place that 312,500 under 31 December 2023. And the question also tells us that in 2026, we're going to sell it for 25,000. So we'll spend 312,500 in 2023. We will then receive 25,000 in 2026. Okay, so let's go right to our question. I'm trying to just plug in the value. So our investment, so this is 2024. So meaning that we have to add one more year, which is 2023. So sometimes you start with some years, but as you do your calculation, it begins to expand depending on the timing of the cash flow. So we call that year 0. So that would be 312,500. That's what you spend. And then in 2026, you're going to sell that for 25,000. Just recognizing the in and out. Out 312,500, in 25,000. That's our investment. The next one would be our working capital. Okay, just a minute. I think I've looked my pen needs to be reset. Okay. All right. So the next would be our working capital. Okay. So I'm a little bit slow on this first part because it's important to understand the principle. When we are doing proposal B, it will be faster because we will not repeat the explanation on tax savings. We will not repeat the explanation on taxation again. It will be faster. But I just needed to calm down a little bit on this first proposal. So let's look at the concept of working capital. So let's spend some time, a few minutes, maybe a minute or two, explaining working capital. Then we'll do our computation. So we can call this working two. Okay, so let's do a few minutes on working capital and then we'll do our computation quickly because it's important to know the principles on that. Working capital. All right. So what's working capital really? It is an amount you set aside for the ongoing running of the business to ensure that the business would often have the necessary liquidity to meet its obligation in the year. So for the purpose of strategic financial management, when you set aside working capital, you're looking at an investment appraisal and you set aside working capital, it is generally assumed that cash set aside is an outflow for a specific purpose. So if I set aside 20 million, it's basically I have 100 million, and I decide to set aside 20 million. What it basically means is that out of my 100 million, I no longer have access to the 20 million technically, because that has been set aside for a specific purpose. So I consider that technically as an outflow because it's set aside for a particular purpose. Now, if I no longer have need to set aside that money, it's assumed that the money is being returned to the business. If no longer needed. If no longer needed. And technically, if you're running a business and you set aside, maybe the business is meant to be for 3 years, and you set aside 10 million in year 1, 5 million in year 2, 3 million in year 3, and maybe 1 million in year 3, and then you get to the final year of the project or the investment or whatever you're doing. In that final year, you're trying to close up the business. You no longer have need. You no longer have need to continue keeping that. You just need to account for that value and close out properly, because after that final year, it is that working capital is no longer needed. So because it is no longer needed, all the amount you have set aside is assumed as being returned into the business. Let's look at that with the example in front of us. So, but in summary, what are we saying? That if you set aside an amount for working capital, it is assumed to be an outflow because you no longer can use that money for any other purpose. It's been set aside for a specific purpose. So technically it is restricted. But if you no longer have need for the working capital, which would always happen in the final year when you're closing out, it's assumed that the cash is returned into the business. So let's see if we can calculate that quickly. What are we setting aside and what are we returning if there's need for that? So let's look at how our capital is computed quickly from our question. Let's look at our question on working capital. Okay, so I'm just going to go to the section on working capital so we're done. Okay. It says working capital requirements in nominal money terms at the beginning of each year are estimated at 10% of the end year operating net cash inflows referred to in the table above. Now let us break it down. The working capital is 10% of the end year operating net cash inflow. So what are the net operating cash inflow? We have it in the table above, and these are the net operating cash inflow. These are 200,000, 275, and 350. So these are the operating net cash inflow. Working capital is 10% of these values. When do we need this working capital? Let's go to our question. When do we need it in terms of timing? It says, when do we need it? It says, no, where's that part again? Working capital. Right. it says at the beginning of each year. That's when it's needed, at the beginning of each year. So timing of cash flow, guys. If I calculate working capital for 2025, for example, or 2024, which is the first year, for example, and that value is needed at the beginning of each year. Based on our explanation on timing of cash flow, the 2025 working capital needed at the beginning of the year will be placed under which year based on the timing of cash flow? Under which year?
2026.
2026. 2025, we said the timing at the beginning of the year will be what? The previous year. At the beginning of the year will be the previous year. So there, yeah, you have it here quickly so that we can, let's do it quickly. Let's quickly take ourselves back to our notes. Right. Very important. Timing of cash flow is very important because students would always sometimes get that mixed up. We said that anything that is at the beginning is assumed to be what? Is assumed to be what? The previous year's transaction. So if we have a cash flow for a value for 2025, if it's said to be at the beginning of the year, it will assume to be the previous year, which is 2024. If we have a 2026, it will assume to be the previous year, which is 2025. So let's do that quickly. Let's do that computation quickly so we can, because I really want us to finish this A part. If the proposal B, it's going to be pretty straightforward because that's would have done all of the explanation with that. Okay, so we're going to use our net operating cash flow. All right, guys, so let's do working capital quickly. I think that's the one major one, and then we'll begin to, okay, so our working capital. We can say it is 10% of operating cash flow. So let's begin with our operating cash flow, which is what we have in the table. So this is 2024, 2025, and 2026. So the values in our table is there are 200,000, 275,000, and then 300,000. All right. So we look at our total working capital, which is 10%. So 10% of 200,000 is 20,000. 10% of 275. Okay, sorry. Let's put it under the right here first so that we can get it. We don't have to do that again. All right. So it's at the beginning of the year. So 10% of 200,000 is 20,000. But because it is at the beginning of the year, that would be under 2023. So that is 20,000. 10% of this is 27,500. But because it is at the beginning of the year, it would be the previous year. So that would be 227,500. 10% of 350,000 is 35,000. But because it is due at the beginning of the year, it will be the previous year, which is 35,000. Now pay attention to how we then determine what values go into our computation, which is our net working capital. Now pay attention to it. In 2023, we don't have any working capital at all because that is the first year. So our working capital value was set aside is 20,000. In 2024, our total working capital increased from 20,000 to 27,500. It increased from 20,000 to 27,500. So what value extra are we adding to the 20,000 to take it to 27,500? It is your 27,500 minus 20,000. So we need to add 7,500 to be able to take it from 20,000 to 27,500. In the year after that, it moves from 27,500 to 35,000. How much are we adding or setting aside additional value to take it from 27,500 to 35,000? It is 35,000 minus 27,500. So what is that value? How much extra are we setting aside? So that's 35,000 minus 27,500. Another 7,500. Another 7,500. Good. Now, in the final year, 2026, we no longer have need for the working capital. So all of the working capital we have been setting aside that we have not used, and apparently in this question, it doesn't mention that we have used any of the capital. So all of the working capital that have been set aside that we have not used, we're going to recover it or recoup it back into the business so that we can close out properly. So in the first year, we set aside 20,000. The year after that, we added 7,500. The year after that, we added 7,500. So all of this amount was set aside that we've not made use of. In the final year, we're going to have that recovered or recouped into the business, and that is a total of 35,000. So this is minus, 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 and this is positive. So all of these values that were set aside in the final year, we're basically recovering it or bringing it back into the business. Any question on how we treat working capital? Please feel free to ask. That's very important that if you have any question. So let me take that one more time, quickly. When you set aside working capital, it is always assumed that fund is restricted. In other words, assume that you can't use that fund for any other purpose except for the specific purpose that has been set aside for, which is working capital. So if, for example, let me use the example I used before. I have 100,000 and I said I'm setting aside 20,000 for a particular purpose. It basically means that what I can spend freely is 80,000. So that 20,000 I set aside can technically be assumed to be an outflow at that point in time. However, if at the end of the day, I no longer need that money for that specific purpose because we're winding down, we assume that you now have unrestricted access to that fund. That's why in the final year, we'd always bring in to our computation all the values set aside before then. So let's get those values up quickly, which is the last value, and then we'll then discount, and then we can then be done with our proposal A. And then in the next class, when we look at proposal B, it's going to be pretty straightforward. Okay, so our values are, because it's at the beginning of the year, the values are 20,000 out, 7,500 out, 7,500 out, and then in the final year, we bring it all in. All right, so that's basically it. So let's do our net cash flow, and then we'll do our discounting, and that will be the end of proposal A. Proposal B will be very straightforward because we don't need to do all of this explanation anymore. So our net cash flow, and then our discount factor, and then our present value. Okay. So 312 rather 500 minus 20,000. By my calculator, I have 332,500. 200,000 plus 25,000 minus 75 By my calculator, I have 217,500. You can double check that with me just in case I press the wrong value. 275,000 minus 80,000 plus 20,000 minus 75. By my calculator, I have 207,500. 350,000 minus 110,000 plus 16,000 plus 25,000 plus 25,000 plus 35,000. I have 316,000 positive. 140,000 minus 54,000. We have 86,000. Okay, guys. So let's do our discount, and then we can then round up to the final part, pretty straightforward part. So we mentioned at the onset that because it is a money cash flow, we must use a money rate of return. But the question gives us the real cost of capital. So we need to calculate what the money cost of capital is. And I gave you guys the formula when we're doing the notes, or when we're doing a quick review of the concept. This is the formula. The money rate of return is equals to 1 plus the real cost of capital, 1 plus inflation rate minus 1. Let's do that for all of the years quickly. Okay, let's do that quickly, and then we can round up. It's almost time. Okay, so we get that completed in less than 5 minutes. All right, so let's do that quickly, and here we are. The money cost of capital. So that would be 1 plus the real cost of capital multiplied by 1 plus the inflation rate minus 1. So let's see what the value would be for our years, which is 2024, 2025, 2026, and then I think we have 2027 that we're paying tax and other things. Okay, so let's do that quickly. Our real cost of capital is given to us in the question and is a constant value. So the real cost of capital is 10% per annum. So it's given to us and it's a single value. So let's do that quickly. It's 10% for all of the years. Right. So that is 10% is 1 plus 0.1. 10% is 1 plus 0.1. 10% is 1 plus 0.1. 10% is 1 plus 0.1, which is 1.1. 1 plus inflation. The inflation rate is different for different years in the question. So let's see what the inflation rates are. So we can use the right rate for the different years. So the inflation rates are 2024, 10%, 2025, 8%, 2026, 6%, 2027, 5%. So 10, 8, 6, 5. 10, 8, 6, 5. So we're going to have that quickly. Okay. So first one is 10. So 1 plus 0.1. Second one is 8%. 1 plus 0.08. Next one is 6%. 1 plus 0.06. Final one is 5%. 1 plus 0.05. So minus 1, minus 1, minus 1, minus 1. Okay, let's do this quickly. So 1.1 multiplied by 1.1 minus 1 is 21%. 1.1 multiplied by 1.08 minus 1 is 18.8%. 1.1 multiplied by 1.06 minus 1 is 16.6%. And then 1.1 plus 1 multiplied by 1.05 minus 1 gives us 15.5%. So you can see that we have different rates for different years. So because we have different rates for different years, let's take 1 minute to do the final part. Let's take 1 minute to do the final part, which is calculating our discount factor. So I explained it when we did our review, or the concept, really. Explain it right here. So because we have different rates for different years, we're going to use this formula depending on the year. So let's do that quickly, then we can round up. Okay, so let's do that quickly finally. Okay, so let's do that quickly. So what is our discount factor? So for 2024, the rate is 21%. So that would be 1 divided by 1 plus 0.21. So which is basically 1 divided by 1.21. If you do that on your calculator, you'd have 0.826. Let me double check that I calculated that correctly. 1 divided by 0.21. 1 divided by 1.21. Yeah, 0.826. For 2025, that has 2 years. 2024 plus 2025. So for 2024, it is 1 divided by 1 plus 0.21. And then for 2025, it is 1 divided by 1 plus 0.188, which is the rate for the second year. So if you do that, you would have 0.696. For 2026, it's 3 years. This, and this. So we're going to do for all 3 years. So it be for the first year is 1 divided by 1 plus 0.21. The second year is 1 divided by 1 plus 0.188. The third year, which is 2026, is 1 divided by 1 plus 0.166. So if you do that correctly, you have 0.597. The final year has all of the years involved. That will be 1 divided by 1 plus 0.21 multiplied by 1 divided by 1 plus 0.188 multiplied by 1 divided by 1 plus 0.166 multiplied by the final year, 1 divided by 1 plus 0.155. If we do this, gives you 0.517. Okay, so I guess we spent our time, so I don't keep you guys much longer. But any questions from what we considered today? Because this principle, we'll move on to our second, the B proposal is going to be much faster, because you already know the principles and all of that. It's going to be faster. So in our next class, which is going to be pretty straightforward, we will just plug in the discount factor that we calculated. We plug in the discount factor that we've calculated in here. We do the present value and NPV. We can then do proposal B. And then the second one is going to be faster, because we will not spend time on the principle we've already discussed. We're just going to focus on any new principles if they are. All right, guys. Thank you very much for this session today. It's a good way to start, really. So you just build on that. So you know that you have a good knowledge as we move on to other sessions. All right, thank you guys, and see you guys in our next class. I would share the notes, the written notes from our class, and then I'll get the video up so that you guys can watch. And those that miss this session, or maybe those that would want to join by January, would always have access to it. Thank you guys, and see you guys next weekend as we continue from where we stop. Thank you. Take care, guys. Bye.
Thank you. Good night, sir. Thank you.
Yeah, good night, everyone. Yeah, good night. Bye.